After every crisis, global trade used to bounce back stronger than before. Supply chains recovered, volumes surged, and growth followed. This time feels different. Trade is moving, but it's not accelerating. And what looks like a slowdown may actually be something permanent. For decades, global trade followed a familiar pattern: disruption, adjustment, and rapid recovery. After recessions or shocks, trade volumes typically rebounded faster than overall economic growth, acting as a powerful engine for global expansion. According to the World Trade Organization and IMF, this pattern has quietly broken. Despite the easing of pandemic disruptions and the normalization of logistics, global trade growth remains structurally weaker than in past cycles. The reason is not a lack of demand alone, but a fundamental change in how trade is organized. UNCTAD data shows that trade intensity, the share of trade relative to global GDP, has stagnated or declined, signaling a shift away from deep globalization. Firms are no longer optimizing supply chains purely for efficiency and scale. Instead, they're redesigning them around resilience, political alignment, and risk reduction. Reuters reporting highlights that companies now prioritize reliability over cost, even if it means duplicating production and shortening trade routes. This reduces cross-border volumes without stopping trade entirely. At the same time, governments have become more interventionist, using tariffs, export controls, subsidies, and security reviews to shape trade flows. These policies introduce friction that did not exist during earlier recovery periods. Unlike past shocks, today's slowdown is not being followed by liberalization or integration. It is being followed by fragmentation. Services trade continues to grow, but it does not replace the scale and spillovers once provided by goods trade. The result is a global trade system that still functions, but no longer accelerates growth. Recovery has turned into stabilization rather than expansion. This is why trade feels stuck, even as economies reopen. What we are seeing is not a delayed rebound, but a permanent shift in the role trade plays in the global economy. If global trade is no longer designed to grow faster than the economy, what replaces it is the engine of global growth. Geopolitics has become the dominant force shaping global trade, replacing efficiency as the primary organizing principle. For decades, companies built supply chains around cost, scale, and speed, assuming stable political relations and open markets. That assumption no longer holds. According to the World Trade Organization and IMF, rising geopolitical tensions, sanctions, and strategic competition have pushed governments to treat trade as a security issue rather than an economic one. This shift has profound consequences. Firms are now under pressure to friend-shore production, source inputs from politically aligned countries, and reduce exposure to geopolitical rivals. Reuters reporting shows that these decisions are often driven by risk management rather than profitability. While this increases resilience, it also fragments supply chains and reduces overall trade volumes. The World Economic Forum notes that trade is increasingly organized within blocks, with flows growing inside regions but weakening between them. This regionalization limits scale efficiencies and raises costs. Governments are also intervening more directly through subsidies, export controls, and national security reviews, further distorting trade patterns. Unlike earlier periods of globalization, these policies are not temporary responses to crisis. They reflect a durable shift in priorities. As a result, trade no longer rebounds automatically when shocks fade. Instead, it settles into a slower, more cautious pattern. Smaller and less aligned economies face higher barriers to entry, as firms concentrate trade within trusted networks. This reduces opportunities for late industrializing countries and weakens the global diffusion of technology and productivity. Geopolitics has not stopped trade, but it has fundamentally changed its character. What once maximized growth now minimizes risk. This trade-off explains why global trade appears stable but fails to regain its former momentum. If trade is now designed to reduce geopolitical risk instead of maximize efficiency, how much growth is the world willing to sacrifice for security? For much of the past 2 decades, China acted as the central engine of global trade recovery, absorbing exports, anchoring supply chains, and driving demand for commodities and capital goods. That role is now fading. According to IMF and World Bank assessments, China's growth model has shifted away from investment-heavy expansion towards slower, more domestically focused growth. This transition reduces China's demand for imported raw materials, machinery, and intermediate goods that once powered global trade rebounds. Reuters reporting highlights how China's property sector slowdown has sharply reduced imports of steel, copper, and energy, directly impacting exporters across Asia, Africa, and Latin America. At the same time, China's export growth has weakened as global demand softens and geopolitical tensions push buyers to diversify suppliers. UNCTAD data shows that multinational firms are increasingly moving parts of their supply chains out of China to reduce political and regulatory risk. While some trade is redirected to countries like Vietnam, Mexico, and India, these economies do not yet match China's scale, infrastructure, or efficiency. The result is a net loss in trade intensity rather than a seamless substitution. China is still a major trading nation, but it is no longer expanding fast enough to lift global volumes the way it once did. Additionally, domestic policy uncertainty and regulatory tightening have reduced private investment, limiting China's role as an importer of capital goods. This combination of weaker demand and supply chain diversification means that global trade no longer has a single powerful anchor. Past recoveries depended on China's rapid expansion to restart global flows. Today, no economy is large or integrated enough to replace that role. Without a dominant demand engine, trade recovers slowly and unevenly. China's changing position helps explain why the current slowdown feels persistent rather than cyclical. If China can no longer act as the global trade engine, which economy, if any, can fill the gap? High interest rates are another key reason global trade is failing to recover the way it did in the past, even though their impact is often underestimated. Trade is not just about demand, it depends heavily on financing. According to the IMF and World Bank, higher borrowing costs reduce investment in factories, ports, ships, and logistics infrastructure that support cross-border commerce. When financing becomes expensive, companies delay expansion, scale back inventories, and reduce long-term trade commitments. The Bank for International Settlements notes that tighter global financial conditions have significantly weakened trade finance, a critical but invisible pillar of global trade. Letters of credit, insurance, and working capital loans are now more costly or harder to secure, particularly for smaller exporters and firms in developing economies. Reuters reporting shows that even when demand exists, shipments are often postponed because firms cannot efficiently finance production and transport. Higher rates also dampen consumer demand in advanced economies, reducing imports of discretionary goods such as electronics, furniture, and durable products that historically drove trade rebounds. Unlike previous cycles, rates are expected to remain higher for longer due to persistent inflation risks and fiscal pressures. This changes corporate behavior. Instead of betting on a quick rebound, firms prioritize balance sheet repair and cost control. Governments are affected as well. Rising debt servicing costs limit public investment in trade-supporting infrastructure and export incentives. The cumulative effect is a global trade system constrained not by tariffs alone, but by the cost of money itself. These financial pressures do not cause dramatic collapses, but they suppress momentum steadily over time. This helps explain why trade appears stable yet fails to accelerate. High interest rates act as a structural brake, reinforcing the idea that the current trade slowdown is not temporary, but part of a permanent shift. If the cost of money has become a long-term constraint, can global trade ever return to its old growth path without a financial reset? One of the most important but least discussed reasons global trade is not recovering is the global shift from efficiency to resilience. For decades, supply chains were optimized to minimize costs by concentrating production in a few locations and moving goods across borders at scale. According to the OECD and World Trade Organization, this model is being deliberately dismantled. Firms and governments now view long, complex supply chains as strategic risks rather than competitive advantages. Reuters reporting shows that companies are shortening supply chains, duplicating production, and holding higher inventories to reduce exposure to disruptions. While these changes improve reliability, they also reduce the volume of cross-border trade. Producing closer to end markets means fewer intermediate goods crossing borders multiple times, which historically inflated trade volumes. The World Economic Forum notes that resilience-focused supply chains are structurally less trade-intensive. This is not a temporary adjustment, but a permanent redesign driven by pandemic lessons, geopolitical tensions, and climate risks. Governments reinforce this trend through industrial policy, subsidies, and national security screening that encourage domestic or regional production. These policies fragment global production networks and limit the scale efficiencies that once powered rapid trade growth. Smaller economies, which relied on integrating into global value chains, face higher barriers as firms prioritize trusted partners over lowest-cost suppliers. The result is a trade system that is safer but smaller. Goods still move across borders, but not with the same intensity or growth momentum. This shift explains why trade volumes have stabilized instead of rebounding. Resilience reduces vulnerability, but it also caps expansion. Global trade is no longer designed to maximize speed and scale. It is designed to minimize disruption. This fundamental change helps explain why the current slowdown feels permanent rather than cyclical. If resilience has replaced efficiency as the core goal of supply chains, how much global growth is the world willing to trade away for stability? As goods trade slows, many point to services as the new engine of global commerce. While services trade has grown steadily, it cannot fully replace the scale or impact of goods trade. According to the WTO and IMF, services such as finance, tourism, software, and consulting are less trade-intensive and generate weaker spillovers than manufacturing. Goods trade historically amplified growth because physical products cross borders multiple times during production. multiplying trade volumes and productivity gains. Services usually do not follow this pattern. UNCTAD data shows that services trade remains concentrated in advanced economies with strong institutions, limiting its ability to drive broad-based global growth. Reuters. Reporting highlights that digital services expand quickly during good times, but are vulnerable to regulatory barriers, data localization rules, and geopolitical restrictions. These constraints fragment markets and reduce scalability. Services also absorb fewer low and middle-skilled workers than manufacturing, weakening their role as a development pathway for emerging economies. While services exports can boost income, they do not generate the same demand for infrastructure, logistics, and industrial ecosystems that goods trade once did. As a result, services growth stabilizes economies rather than accelerating them. This explains why global trade looks functional but fails to regain momentum. The shift towards services softens downturns but caps expansion. Without a strong rebound in goods trade, overall trade intensity remains subdued. Services can complement trade, but they cannot replace the growth engine that manufacturing once provided. The global economy is adjusting to a trade system that is structurally less capable of driving rapid expansion. If services trade can stabilize the system but not accelerate it, what happens to global growth when goods trade stays weak? What began as a response to crises is now solidifying into a permanent feature of the global economy: trade fragmentation. According to the IMF and WTO, global trade is increasingly organized around political alignment rather than comparative advantage. Countries are forming tighter economic blocs, prioritizing partners that share security interests, regulatory standards, and geopolitical goals. Reuters reporting shows that sanctions, export controls, and national security reviews are no longer exceptional tools. They are becoming routine instruments of economic policy. This shift discourages firms from building globally integrated supply chains that span rival blocs. Instead, companies duplicate production across regions, reducing cross-border flows between blocs, even as trade within them grows. The World Economic Forum notes that this fragmentation raises costs, lowers efficiency, and limits technology diffusion, especially for countries outside major alliances. Smaller and developing economies face tougher choices, as access to markets increasingly depends on political alignment rather than competitiveness. Unlike past trade disruptions, fragmentation is being reinforced by long-term policy commitments, including industrial subsidies, strategic stockpiling, and domestic content rules. These measures lock in new trade patterns that are difficult to reverse. Fragmentation does not stop trade, but it reshapes it into a less dynamic system with weaker global spillovers. Growth becomes more regional and uneven. This helps explain why global trade volumes appear stable while momentum fades. The world is not moving toward renewed integration. It is adjusting to a fragmented equilibrium. In such a system, rapid trade-led recoveries become unlikely, and the global economy must adapt to slower, more compartmentalized growth. If trade fragmentation is no longer temporary, how will countries outside major blocs survive in a more divided global economy? The permanent shift in global trade is hitting developing countries harder than advanced economies. For decades, trade-led growth offered a clear development path: integrate into global value chains, export manufactured goods, and climb the income ladder. According to the World Bank and UNCTAD, that path is now narrowing. As trade fragments and firms prioritize trusted partners, many developing economies find it harder to attract investment and secure stable export markets. Reuters reporting shows that supply chain diversification often favors countries with existing infrastructure, political alignment, and institutional capacity, leaving poorer economies behind. Even when production relocates out of China, it concentrates in a small group of countries rather than spreading broadly. The IMF notes that reduced trade intensity limits technology transfer, learning by doing, and productivity gains that historically supported development. Commodity exporters face additional pressure. Slower goods trade reduces demand growth while price volatility remains high, increasing macroeconomic instability. At the same time, higher interest rates and tighter global financial conditions constrain access to trade finance, disproportionately affecting smaller exporters. Services trade offers limited relief, as many developing countries lack the digital infrastructure and regulatory environment to compete at scale. The result is a widening gap between countries that can adapt to the new trade system and those that cannot. Trade is no longer a rising tide lifting all boats. It is a selective channel that rewards readiness and alignment. This shift raises the risk of stalled development and prolonged income gaps across much of the global south. The permanent trade slowdown is therefore not just a global growth issue, but a development challenge with long-term consequences. If trade no longer provides a reliable development path, what options remain for countries still trying to escape poverty? As global trade loses its role as the primary engine of growth, an important question emerges. Can any single country or region fill the gap? The evidence suggests the answer is no. According to the IMF and World Bank, trade-driven growth worked because it was global, scalable, and mutually reinforcing. When many economies expanded together, demand, investment, and productivity fed into one another. That dynamic is now broken. No individual economy is large, open, and fast-growing enough to substitute for a globally integrated trade system. The United States remains a major consumer market, but its growth is constrained by debt, demographics, and policy uncertainty. China, once the anchor of global trade expansion, is transitioning to slower, more domestic-oriented growth. The OECD notes that Europe faces structural constraints, including aging populations and low productivity growth, limiting its ability to drive global demand. Emerging markets are fragmented and increasingly constrained by tighter financial conditions and geopolitical alignment pressures. Reuters reporting highlights that regional growth engines lack the scale and openness needed to recreate past trade-led expansions. Domestic consumption-led growth can stabilize economies, but it does not generate the same cross-border spillovers that trade once did. Industrial policy and reshoring initiatives may support national resilience, but they fragment demand rather than amplifying it globally. This means the world is entering an era where growth is more localized, uneven, and constrained. The loss of a shared growth engine makes global recovery slower and less synchronized. Trade is no longer the force that pulls economies forward together. Without a replacement mechanism, the global economy must adjust to structurally lower growth and greater divergence between winners and losers. If no country can replace global trade as the growth engine, how does the world avoid a long period of stagnation? The permanent slowdown in global trade marks a fundamental turning point for the world economy. For decades, trade expansion amplified growth, productivity, and income convergence across countries. That era is now fading. According to the IMF and World Bank, a less trade-intensive global system means slower productivity gains, weaker investment spillovers, and reduced efficiency across borders. Economies will rely more on domestic demand, fiscal policy, and regional integration to sustain growth. This shift makes growth more fragile and uneven as countries with strong institutions, capital markets, and policy capacity adapt more easily than those without. The OECD notes that lower trade intensity also limits competitive pressure, reducing incentives for innovation and cost discipline. Over time, this can entrench inefficiencies and slow technological diffusion. Reuters reporting highlights that global shocks will increasingly transmit through financial markets and geopolitics rather than trade volumes, changing how crises unfold. Instead of sharp collapses followed by rapid rebounds, the global economy may experience longer periods of stagnation and adjustment. Trade will continue, but it will no longer serve as the automatic accelerator it once was. Policymakers face difficult choices. Protecting resilience and security comes at the cost of growth and efficiency. Ignoring this trade-off risks misreading the new economic reality. The challenge ahead is not restoring the old trade model, but managing a world where growth is structurally slower and more fragmented. Countries that recognize this shift early can adapt their strategies toward productivity, skills, and domestic resilience. Those that cling to the old model risk falling behind. The permanent shift in global trade is not a temporary phase. It is the new baseline shaping the future of the global economy. If global trade can no longer drive growth the way it once did, which economies are prepared for this new reality and which are not? For calm, data-driven explanations of how the global economy is really changing, stay with Wealth Woven and keep looking beyond the headlines.